Welcome to the Shenkman Wealth Management Accountant Attorney Spring Webinar Series. This program is entitled State Tax Audits, Preparing for the Inevitable. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients to achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. You can see all my work on my website at shenkmanwealth.com/articles or by following me on social media at Shenkman on Money. One more quick note before I introduce our esteemed speaker, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Scott Clark, counsel and chair of Dave Pitney's Multistate tax practice. For the last 30 years, Scott has been at the forefront of the state and local tax controversy world. He's well-versed in the intricacies of state tax planning, audits, and tax controversy in most of the 50 states. He has handled a wide variety of tax audits and issues for both ultra-high net worth individuals, estates, family offices, and prominent entertainers and personalities, and significant U.S. and multinational companies, particularly those on a focus with the telecommunications, technology, digital products, retail, and media. Prior to joining Dave Pitney in 2021, Scott was a longtime tax partner with Dentons in New York City. In the late 1990s, during the height of the telecom and internet bubble, he was a partner and the co-leader of the PricewaterhouseCoopers National Multistate Tax and Legal Services Communications Industry Tax Practice. Earlier, he served for 9 years as the Associate Tax Counsel for the GTE Corporation, which is now Verizon, where he was the Chief Legal Advisor and Counsel on issues on executive compensation and benefits, and also on all state tax audit, protest, and litigation matters throughout the country. Today, Scott will be speaking on the state tax audits, preparing for the inevitable. And with that introduction, I'll now turn the program over to Scott.
Jonathan, thank you very much, and appreciate that introduction, and glad to be with you. Jonathan and I were chatting before, and we are reminded that today is tax day, April 18th. So I hope you all are in good shape out there, or will be by this afternoon. My practice, as Jonathan alluded to, deals mostly with state tax issues of all sorts. And a good portion of my practice focuses on some very interesting people in the entertainment world, some very high net worth people, and quite a bit of family office issues. And so for purposes of our discussion today, I thought I would focus on a number of those issues that I deal with on a daily basis. And so we call this state audits, preparing for the inevitable. And it's preparing today for those inevitable issues that I see consistently arise and are issues that taxpayers and family offices consistently have to deal with. By the way, as Jonathan alluded to, there is an outline. Please feel free to review that at your convenience. I'm going to kind of talk through those very same issues, but am not going to specifically refer to it. On that outline, you'll also see my contacts. So if you have any questions or follow-up questions or curious about issues, please feel free to reach out through email or otherwise, and I'd be happy to respond. I thought, again, the issues we'd cover today are residency issues. And residency covers a couple of sins, so to speak. It covers the issue of domicile, and it also covers the issue of what's called statutory residency, and we'll get into those. Also, particularly in light of COVID, which I still mention, but is clearly waning at this point, we still are living with the issues of remote work. And to that end, we have issues of taxation. New York has I'll call it the infamous convenience of the employer rule. Other states have followed that. And then as a result of remote work, there are thorny nexus issues, which are triggered for the companies that we all work for. Nexus with respect to income taxes and sales taxes. With respect to audits themselves, I've seen, and I think most of my colleagues have seen, a clear uptick in terms of state audits and inquiries. And quite frankly, those issues today are much harder to deal with, mostly because states, in particular New York for one, have been losing and lost quite a number of personnel, and they've lost quite a number of senior people. As a result, there's a whole lot of institutional knowledge that's left those departments. It's simply gone out the door in terms of retirements and otherwise. And that's why it is typically much more difficult today to resolve some of those basic issues. It's much more difficult to resolve issues of residency, domicile, and also nexus. On top of that, we still are left with a state need for revenue. To give you some of the numbers, I just pulled these off the internet in the last day or so. California, for one, has still a building deficit, 22.5 billion today, as well as states like New York State, New York City have increasing projections on deficits. New York State about 6.5 billion increase over the next 4 years. And New York City is projected to have a deficit of about 14 billion by 2027. And although state administrators may not admit it, one has to think that those deficit numbers do in some way come into the fray when trying to resolve these issues at the state level. So let's talk about residency. I'll call it, to start off, the great shift to the low or no tax states, the great shift to Florida, a no tax state. Similarly, we see that, although less so perhaps, to Texas and perhaps Nevada. But in considering the shift to Florida, a couple of points to keep in mind. The Florida population, by the way, I believe for the first time now exceeds the New York population. Florida at about 22 million as of the end of 2022. New York at 20 million, same at the end of 2022. Yeah, it is quite interesting to note, or I find it interesting to note, that the Florida budget, the state budget, is about half of what it is in New York. The Florida budget at 115 billion, New York state budget at 232. So again, while the population of Florida is slightly more than New York, their budget is about half. And unfortunately, my experience with clients is you note that with respect to the budget applied to folks who are of lesser means, who are with disabilities. Now, any change in residence, be it from New York to Florida, or a Northeast state to Florida or Texas, one can, in my view, expect at least an inquiry and quite possibly an audit. I'm told by the most senior people at the New York State Tax Department that this level of audit has apparently slowed, but frankly, in my practice, I haven't seen it. Clearly in 2021 and for the most of 2022, whenever one changed his or her status from resident to non-resident on a New York State return, one could expect at least an inquiry. And again, if the dollars are significant, I would expect that today, if not an inquiry, certainly an audit. The problem, of course, is that these audits are quite intrusive. The audits today, similar as in recent prior years, can last at least 12 to 18 months on the optimistic side, up to 24 months or more. And if you factor in the time for appeals, you're talking about a period of years typically to resolve complicated issues. And in the meantime, you've got to keep in mind that interest keeps on ticking on these assessments. So they become today even much more difficult to deal with. To put the issue in perspective when talking about the issue of residency, and we'll get into domicile and statutory residency in a minute, keep in mind overall that when you're talking about a resident of a state, New Jersey, California, New York, wherever, a resident is taxed on all her income, no matter where it is earned. Whereas if you are a non-resident, the tax is only on the state source income. That is on the in-state wages earned, rental from state property, or gains from state property. Again, non-resident taxed only on state source income. With that in mind, let's talk first about domicile. And what does domicile mean? Domicile, of course, is a question of intent. Where does one intend to live? The case law talks about it in terms of where is one's heart? It's a question of intent, right? And I always say people come to me and they get an inquiry from the state on residency and they ask me how to handle it. But the first question they really need to think about and really need to resolve is totally aside from the tax issue. Where do they intend to live? Where do they want to live? Where do they intend to return? I always say tax should never sway the dog or wag the dog. The first question is, where do they want to live? And once you know that, you can best approach the issue. Quite frankly, for those individuals, and I'm using New York, but it could be any state. I deal with these issues all over the country, but I'm in New York today. So thinking about New York, if one, as typical, wants to keep the condo in New York and maintain it because they've lived there with family for many years, maybe that in fact is their domicile. And so again, the first step is, where does one intend to live? Where does one intend to return? Many states have very difficult and thorny issues when thinking about domicile. Again, we'll talk more about New York and the Northeast states, but just to mention a couple of others, California, you're deemed to be a domiciliary if you have a physical presence for other than a temporary or transitory period. In Georgia, every person is a resident who resides within the state for more or less a regular, on more or less a regular or permanent basis. When we talk about domicile in the Northeast states, typically Maine to about Delaware, we look toward what's called the NASTOA protocol. NASTOA is the Northeast States Tax Officials Organization. And that is an organization, again, of all the 12 or I guess 13 states in the Northeast, essentially Maine to Delaware. About 25 years ago, I was privileged to be involved. Those Northeast states got together at the NASTOA meeting and put together a protocol. It's essentially a protocol of the 5 basic factors which any Northeast state will look at in order to determine where one's domicile is. And those factors are the ones that we typically talk about. It's the home, time, items near and dear, where the active business, and to a little bit of a lesser degree where the family is. So in looking at those factors, again, home, we look at where the homes are, be it in New York, New Jersey, Florida, wherever they are. We look at the cost, we look at the opulence, we look at the size, and we compare them relatively. Those homes in New York or New Jersey or Connecticut versus those homes in the remote state, Florida, Texas, Nevada, wherever. We look at the amount of time spent. And what we want to see is, of course, we want to see the overriding amount of time in that state where you'd like to be a resident. So if you're claiming a residency in Florida, we want to see the overabundance of your time, the day count in Florida. Third, we look at where items near and dear are located, under the thought that the items that are near and dear to you, whether they're classic cars, books, artwork, coins, jewelry, that you keep them close to you at your own residence, your own domicile. Fourth, we look at where your active business is. Where is the center of gravity with respect to the business you do? And fifth, and really only fifth, we look at the family. And family is much more important when you have a young family. That is, you have young kids that go to school, but much less important if you're older. Finally, we look at something called other. And it's interesting to note that other is that whole plethora of other contacts that folks typically talk about, right? Where your cars are registered, where you vote, where your clubs are, where your doctors are, where your lawyers are. It is this category of other that, quite frankly, in the NASTOA protocol are not one of the 5 factors. Nonetheless, we still see today that many of the tax departments and many of the cases, we see this particularly in Connecticut, still focus on these other factors. I would submit to you, though, however, that those other factors are much less important than the 5 main factors. And they're much less important because they're much more susceptible to manipulation, right? To a fair degree, I can manipulate where my doctors are, my lawyers are, where my club memberships are. Perhaps even I can manipulate where my friends are. So in my view, and I think still true today, certainly true under the NASTOA protocol, the other factors are much less important. In considering those factors, there are maybe 2 or 3 other concepts that we need to layer in that are really important. In order to determine domicile, particularly a change of domicile, the burden on us, the taxpayer, is extremely high. In fact, it is the highest burden. It is a burden of clear and convincing evidence. So we must show a change of domicile. Again, I'll use New York. Forgive me, it could be anywhere. But New York to Florida, California to Florida, California to Texas. We must show that change of domicile by a clear and convincing evidence standard. Further, we need to show, particularly in states you see this like Georgia and other states, but true in just about all states, we need to show not only that you've moved, not only that it's clear and convincing based on the evidence that you've moved, but you need to show abandonment of the state. Folks call that leaving. We need to show we left, we abandoned, we left, and we landed, right? We left New York and we clearly landed in Florida. And you need to show that based on the facts. And furthermore, in developing this story that we call change in domicile, we need to do just that. We need to develop a story, right? We need to have a reason for the change in domicile. One logical reason can be retirement, right? Retirement can be a very logical reason to move down to Florida. Change in business, change in firm, change in company can be a very logical reason to move from one state to another. But in my view, it's really important to tell a story as to what the basis is for this change. One other point, there are a couple of safe harbors. I'll note the one important safe harbor is the 30-day safe harbor that many of the NISTOA states and many other states adopt. It simply means that, for example, in New York, if you give up the home in New York, you have no home in New York, but you have a home in Florida, and you're in New York for less than 30 days, you will come within that safe harbor. And by that, you will not be deemed a domiciliary of the state. And so it's important to keep that safe harbor in mind. When talking about domicile, I've been talking about it here for purposes of the income tax. But keep in mind that it's the very same test for estate taxes. And for those of you who deal in the estate tax world, me included, we see that issue come up quite a bit today, where states are making determinations, Connecticut, New York, other states, that individuals are domiciled in the state for purposes of the estate tax. And the consequences there can be much more significant when you're talking about a particularly large estate. Now, thus far, we've been talking about the issue of domicile, right? But when dealing with residence, residence includes domicile, but it also includes this concept called statutory residency, which is a mere creature of the statute and hence statutory residence. And there are two pieces to whether one is a statutory resident. One is a statutory resident if, for one, she maintains a permanent place of abode for substantially all of the taxable year in the state, and she's in the state for more than 183 days. So essentially, one maintains a home in the state for substantially all of the year, not all of the year, but just substantially all of the year. Plus, one is in the state, the day count, for more than 183 days. Now, when considering the day count, remember that a day doesn't have to be a full day. A part day counts as a day. And with respect to whether you maintain a home for substantially all of the year simply maintains that you have that home in the state for 10 months or more. I'll talk about one interesting case that came down the pike at later in 2022, and that's the Obis case. And the Obis case deals with what does it mean to have a home in the state, right? What goes into having a home? Essentially, is if you have a home, how do you determine whether you view it as a home? Here, essentially, the individual had a vacation home. Nelson Obis had a vacation home located in upstate. I think it was near Albany. It was 4 hours from the city. He merely used it 2 or 3 weeks a year. He had a tenant occupying part of the home, and he kept no belongings there. So essentially, Mr. Obis would go up, I think he went skiing for 2 or 3 weeks a year. He'd bring his belongings with him. He kept nothing there. And that was the extent to his use of the home. New York State said they viewed that as a home because objectively it was a home. It was a 5-bedroom, 3-bath home in upstate New York. It wasn't a summer cottage. It could be used all year round. It had heat, it had air conditioning. Obis, on the other hand, asserted that it was not a home, that subjectively it was for vacations. Because it was 4 hours away from New York City where he worked on a daily basis, he did not view it as his own. And somewhat surprisingly, the appellate division of the New York courts agreed with him. And so today we have a new standard. And that standard is that for purposes of the statutory residence test, you determine whether you have a home based not on the objective criteria, but based on your subjective intent. That is, how do you view that home? One more issue in the next few minutes that I thought I just raised is a separate issue, getting away from residency, and that's this quirky convenience of the employer rule in New York. Many of you know, many of you may have to deal with this issue called convenience of the employer that says essentially, if you have an individual, an employee who is an employee of a New York office, then all the wages that he or she has will be taxable in New York unless those wages are earned outside New York as a result of necessity to the employer. In other words, the employer necessitates, requires you to be out of state. That standard is seldom reached, particularly in times of COVID and currently, because people are working remotely, clearly not because the employer requires it, but because they would like to do so. And as a result, we see a number of cases that have gone and are going up the pike with respect to convenience of the employer. Most notably, currently, we see Ed Zielinski's case. Ed is a professor at Cardozo Law School in New York City. He is currently litigating his case in New York. And so we'll see what comes out about that. But essentially, he raises the issue that the standard should not apply to him because particularly in 2019 and 2020, he was required to work out of state in his home in Connecticut, and therefore should not come within the convenience of the employer rule in New York. And therefore, New York should not get all his wages for 2019 and 2020. And as I say, as that case goes up, it'll probably be in litigation unless they can work out some settlement. It will be in litigation for, I'm sure, a good amount of time, and we'll see how that comes out. But with that in mind, there are a number of other issues to go through. I think I'll stop there. I see our time is about up. Jonathan, I'll circle back to you, and I would simply say that if folks have questions or any follow-up, if it's okay, please feel free to reach out. Jonathan, with that, I'll transfer back to you.
Great. Thank you so much, Scott. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Scott or myself where appropriate. I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones that are served by a team of knowledgeable advisors. 3 more very quick items before I let you go. First, my spring webinar series continues on Thursday, May 4th, with an exciting panel discussion entitled Coming to America, Pre-Immigration Tax and Estate Planning Considerations. This program is for 1 CLE and 1 CPE credit for accountants or lawyers in New York or New Jersey, and features K. Eli Akhavan from Steptoe & Johnson, Lawrence Lipoff from Cohn Resnick, I'm Michael Wilds from Wilds and Weinberg, and I'll send out an invitation to this and all of my upcoming webinars after the program. Second, if you or a colleague would like to be kept abreast on my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow my work on Twitter, YouTube, and Instagram at Shenkman on Money. And finally, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. With that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.